Stocks exploded higher to start the week, fueled by a major geopolitical surprise, the 90-day tariff truce between the United States and China. With that, the Dow soared over 1,100 points today. The S&P jumped over 3%. Tech stocks led the charge, with the Nasdaq rocketing over 4% higher. And today's rally wasn't just a headline driven, it was a full-blown risk-on move. Small cap stocks moving higher, semiconductors moving higher. Even international markets moved higher in unison. But as investors cheered this breakthrough, deeper questions remain. Most of this move occurred overnight, and we didn't build on this. So will the momentum hold? What does this mean for inflation and the Fed's next move, where rate cuts were being priced in? Where are they at now? And are there cracks beneath the surface that we need to pay attention to, that we've seen in prior moves like this before? So in this market outlook, we'll break down the macro catalysts behind today's rally, take a look at some charts that are driving this momentum, and explore where we go next as the CPI data looms large tomorrow. So let's go ahead and get started. Today is Monday, May the 12th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right. You can sign up for our newsletter either with this form right here on the right-hand side or this subscribe free button up here at the top. We also have our Market Outlook Lives, where I take a look at the trades that we've done in Market Outlook videos and we manage them. We closed a few of them today. We talk about that and why. You can also see a little bit of a recap, a written recap of today's market down below the video. And then here at the bottom, click this heart. It opens up this tab. Hit that like button there that pops up eventually. There we go. There we go. And same thing here. Click that thumbs up icon. It opens up this tab. Opens up today's Market Outlook post again. Click that like button down there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in, day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. And we blew out today here above the high point of the failed pullback bounce. Right, we had the pullback to the 200-day moving average. We bounced, we failed, and we rolled over, and now we have cleared that failure with a nice little bump today. We got dark green shading, which means the intermediate line is rising above the 50. It's actually about anything it does above the 80th percentile gives it dark green shading. And you're above a rising moving average, so you have a green line. So dark green shading and a green line. Nice, good, strong move. Most of it occurred overnight. We had a 59-point range, so it was about half, almost half the average, about almost 50, exactly 50% the average range. So most of the range, like we closed at 56.59. The low was 57.86. So you had quite a few. Let's see here. What would it be? About 41 points to get you 5,700, and then another 86. So you're looking about 120 points plus that occurred overnight, and only 60 occurred in the daytime. So the overnight range met the average, but then we rallied and had even more. So that kind of goes to show again just how much of the move occurs before anybody can really do anything about it. Unless, of course, you already been bullish considering the rise that it's already had. So as a result, you did what's interesting is you did not get the cluster, the overbought cluster. Now you're probably getting an overbought cluster tomorrow, assuming that we stay this bullish and we close near the high of the day. We'll probably end up getting an overbought cluster tomorrow. But yeah, interesting that we didn't get an overbought cluster today because of that. Because again, it's better if we just rally all throughout the day. Right? If we ended up with a 160-point range today and it occurred all throughout the day, that would have been super strong. Then you would have gotten the MACD, the momentum in the near-term line up here, and you would have been strongly bullish. You still would be the same percentage above the moving average, which is a high percentage, 7% here. Let's see, what did I have this line at? Let me see really quick. 7, so that's 6.92. So that's what it was earlier. So we finished even higher. So we finished at 7.09%. Just for some perspective on just how far above the moving average we are right now, the 30-day moving average. Like the last time we were this far up above, sorry, let's zoom out again, was the last time we were this far up above was right here. You were just over 7% in August of 2022. Of course, that was when Powell came out and basically said we're not going to cut rates, and we ended up getting this move, right? This move right here. We ended up falling down. I mean, we were in the midst of a correction, and we ended up getting lots of oversold clusters on the way back down. That was the last time we've been above 7%, above the 30-day moving average. Before that, it was right here when we had this parabolic move in June. We had a little bit of a pullback down to a bull tag, and then we bounced up and went parabolic again before we actually had an intermediate decline there in September going into the November 9th. Now, this is the biggest gap to the upside that we've had since this November the 9th, where you had two things happen over that weekend. You had Biden declared the president on November the 8th, and you also had Pfizer, I think it was either Moderna or Pfizer's vaccine was deemed 90% effective with the COVID. And so that Monday morning, we just gapped up big to the upside. So, and then of course, coming off the COVID low, we got well above the moving average there too. As you can see above, the red dotted lines where we're at right now. And then before that, you have to go way back to be this far above. The last time before that was October, coming off the August, the credit crisis lows. This was a correction though. We got this far up above. We ended up getting over 8% above, and then we had an intermediate decline, to an oversold cluster, a bull tag, an oversold cluster there, and then we rallied again, but it produced a pullback there. Again, coming off a correction low, just like we are now, and then before that it was 2009, a couple of times in 2009, coming off the bear market low that we're above that. And so needless to say, this is a large move to the upside. I mean, we were already pretty strong. I mean, we weren't above the 5% mark, but today really pushed us over the top in a lot of ways, as you'll see throughout the video today. If you take a look at the weekly chart, big, strong candle. Again, you can see just how big that candle is. Again, it's very rare for the candle to be this large, the size of this candle. And not only that, but the last three candles have been so big. That's what this purple line is, the average of the last three lines, three candles. So if you look at that one, which is right now just at 4%, so it's how big the bodies are in these. So, and you can see again, it's a 3-period average. So it's looking at the last 3 weeks, and they kind of go to show again just how big this last 3 weeks has been. Now, granted, we're only one day into the current week, but to kind of show you how, like, again, we'll look at the purple line, not the green line, because the green line's getting up there, but you can see that same August move we also had, we got close. We didn't quite get to 4%, but you got really close as we got to the end. Some really large candles over a long period of time, 3-week period of time. Before that, of course, was COVID, the move coming off of COVID, really significant move coming off a very significant low point there. And before that, again, you have to go way back over here to that same 2011 time frame, where again you had a big 3-period move before you had a little bit of a pullback, and then we rallied up there. So you can kind of get the idea just how then there's the bounce coming off the bear market lows, and before that nowhere close. So again, very, very rare to get the size of move that we are above the 30-week moving average, and to get the size of these candles. The great thing is that we are clearly above both the 10 and the 40-week. The PPO is currently slightly negative, but well on course to getting positive and to ending. Again, this would be the probably the shortest lived correction that we've had in quite some time. I'm sure there's always something, but there hasn't been a correction this short in a very, very long time. If you look at the 3 green arrows, obviously we still have 3 green arrows. Excuse me. Has been the case now. Now it's the thing for the S&P and the Dow is the moving average is just turning green. Same thing with the Russell 2000 for that matter. It has been green mostly for the Qs, because the Qs have been more bullish than the rest. but you're finally getting, you know, the 3 green arrows and the green line, which is a good sign. Your MACD is pretty strong. You're almost at 1.5. Again, this is, you know, just to kind of give you an idea of just how strong this momentum move is, because this is a PPO, so you can look at this on an apples to apples basis going backwards in time. And here I'll get rid of that volume profile so we don't have to see that. So again, you can see in 2023 we had a big move. Again, a much smaller decline than what we just barely had, but a big move there. You can see some of these other PPOs again in August of 2022, coming off the COVID lows. March of 2022, the PPO was this high, and we were above the moving average, 200-day moving average, just like we are now. We kind of gapped up there too in March 29th of 2022. Obviously, it wasn't as big of a gap as we saw today, 3% gap. We ended up closing up 3.3%, so we actually built on the gap this go around. But if I go back to March 29th of 2022, so right in here, it would be March 29th, there. So we had a pretty decent gap, but it was only like a 1% gap at the time. So it was more than one standard deviation, but not nearly to the same degree that we just saw here today. So big move up, big move up. And here's the, I mean, again, above the 200-day moving average. The 8 and 17-day have crossed above the 50-day, having already crossed above the 30. You can see the stochastics at bullish levels, you know, like it's above the prior pullback bounce, failed bounce high point. Again, that happened in March of 2022 as well. We also bounced up, broke up there in March of 2022 and closed with that gap there at the end, up above the the failed pullback bounce high as well. So nice move there from that perspective. Now this is where things finally get interesting, because, you know, we've been waiting for so long to get this breakout move, and we finally did today. Almost above 30 on the positive indicator, almost below 20 on the negative. I mean, that is what we've been watching for, and we finally got that there. The RSI and the CCI, you can see now I can turn it green because now we've closed above 60, so we can go back here and turn that green there. We got above 150 on the daily CCI. The weekly still got some work to do to get above positive 100, and that's when I can start a new green box there. But you know, and see, we had that in August as well, so that's not the end all be all, but it's better than nothing. It's better than not having it. It'd be better, you know, than, you know, if we were to peak right now. You can see the RSI is back above 50 on the weekly. That's a good sign. Again, that happened both in March and August, so that's not the end all be all necessarily either, but still, it's a good sign. When you look at the Ichimoku cloud, we got above the cloud. The rate of change turned positive. And the rate of change, you can see the red line here is above this close. Tomorrow and the next few days, the close is really going to go down. So that red line is basically plotting this indicator, this rate of change. We close up 8.25%, and it's about to spike in a big way tomorrow. So, I mean, we're already pretty high, relatively speaking. But remember, that's based off of this low point being day one. This is going to be day one tomorrow, and then, you know, the day after that, and then the day after that. So unless we really drop and fill in this gap, the rate of change is about to explode to the upside. Seriously, I mean, in fact, if we don't move anywhere tomorrow, and we're as flat as a pancake tomorrow, 58.44.19 divided by a close of 50.74.08. Then we jump up to, it jumps again with no gain at all tomorrow. If we were just flat as a pancake, then the rate of change over 26 days jumps to 15.17%. That's way up here. That's the biggest, that would be the biggest rate, 26-day rate of change over 26 days in a long time, 15.17. You can see if I were to put this on right here, so right about in this area here. I mean, COVID, and then of course this 2018, we were pretty close, like those. And again, that's assuming a flat day. If we gain it all tomorrow, and also keep in mind too that the low gets even, so by 2 days, if we're flat over the next couple of days, then it goes up to this low point here of 49.8277. Now we're up at 17%, 17.25%. So you can, again, that's a tremendous move up to the upside that pretty much moves, puts all of this to shame. Again, now we kind of need to avoid filling in that gap. As long as we avoid filling in this gap, which I'll show you here in a minute, it's probably most likely a breakaway gap. But again, I mean, this is a significant low point over 26 days, a significant run over 26 days that is just so uncommon and so rare, considering again how high like the CAPE ratio, for example, already is, and how low the VIX was until this move. The VIX was already like flirting with like the low 20s by the time we got this jump here today. Let's take a look at so we looked at the Ichimoku cloud. Let's look at the Bollinger Bands and the Keltner channels. We are in the upper quartile of the bandwidth. We're in that 90th percentile, so that's good. But what's really positive is we close above the Keltner channel, which is very good. I told you when there's a gap between the two lines, we tend to fill in there. We definitely filled in there. You can see that big high momentum, which is not surprising. So it's not, it's probably not going to this isn't going to spark a huge run. A little bit of a long lower shadow there, which is probably not the best. But still, that's a good move in getting above the Keltner channel. I mean, these are all bullish breakout patterns. And I would say too, like when you look at the intraday chart, the higher there, when we had a huge gap up, we kind of came down and filled in some of the gap right away, but then we kind of established a low early and never really got below that and finished near the high of the day. So not a runaway gap, because we're not starting an intermediate decline. We've already been on one. We've already started this bullish one a while ago. The intermediate line, like I said, we almost got a cluster. The intermediate line's been, it's been rising we've been dark green shading for a long time. But really, what we are getting here, is what I think is a breakaway gap. So we gapped up, and with the gap that we have here, we gapped above the 200-day moving average, and we gapped above this high point and pretty much stayed above that high point the whole time. So that would be considered a breakaway gap, which is also a gap that doesn't get filled in very often. So now if it gets filled in, then it's a common gap, and that would be very bearish. To get this big of a gap up to the upside, I mean, essentially at March 29th of 2022, if we gap up this much and then we fill all that in, the sentiment doesn't stay as bullish as it was today, then the common gap would be very bearish for the markets going forward from here. But again, considering it's a breakaway, considering you broke above some resistance levels here, there's a very high probability that we don't fill that in, because again, breakaway gaps, runaway gaps don't get filled in, relatively quickly, like common gaps would be, or like exhaustion gaps. There is some possibility this is an exhaustion gap, considering again that we've got a red tag or green tag that we've been working on that's already up to 13% off this low, so you're already in double digits. So we did get a long lower shadow, so there is that possibility it's an exhaustion gap rather than a common gap. But again, same thing. I mean, that is a common gap that like I said would be more bearish than regular common gaps because of how bullish the move already was, and considering the dramatic shift in sentiment from being so strongly bullish to now not being that strongly bullish would be a change that we don't want to see in the markets. Let's take a look at. I showed you the range, and the trading range was about half the norm. But again, we have to keep in mind that you had about a 12-point range overnight from 564 to a low of 577. So yeah, you had about a 12-point range, almost 13-point range there overnight, which was the average. And then you had another 6 points tacked on top of that from the open. You can see that the volume, though, as big of a move as this was, the volume is actually below average at 79 million. So they've been on such declines. The ATR actually does take into account that gap. They've been on such declines that we should have had considering we're breaking through some resistance here, there should have been some volume to go with that. So that's a little bit of a discouraging sign that the volume didn't, but again, it's not surprising considering we gapped up 3%, and there's not a whole lot of people who would like to chase that, right? That's why we had such a small move. It's like, okay, are we Like that was a strong bullish move, but all the strong bullish sentiment occurred in very illiquid markets overnight. So, is bullish sentiment strong enough that we're able that the market can build on this? That's the question. And right now, considering the lower volume and the fact that we only went up 6 points today, or had a range of 6 points today, suggests that we might not be as bullish as we were in the overnight session here in the regular session. So it might be harder to build on that than we may think it is right off the top, when you just see how bullish of a move and how many breakout signals we got from it. We did drop below 20 on the VIX. That's a very, very good sign. We dropped below 95. We didn't get below 90. So that's not as great of a sign there. We like to get below 90. The VVIX did drop below 90 itself. That is a very, very good sign for the markets. And then finally, the other thing we've been watching for on the VIX is for it to get below the 200-day moving average, and it did get below its 200-day moving average. So very, very good signs. One small, not so great sign, but still good, right? It's low. It's below 20, but and it's below 95%, but it needs to get below that 90%. And we are that's about as good of a sign as we could possibly get on the VIX there. Let's see here. All right, now let's take a look at what's driving a lot of this price action. Again, international stocks have been doing very, very well. Like this kind of goes back almost to the beginning of this. You can see the decline started on the 20th. So if I were to zoom out here and just take a look at February the 20th, that's when the correction started. That's where we ultimately peaked. Here, let me get rid of that 5 minute and go to like half hour. You can see that's where, by the time equities had bottomed out, bonds were up and gold was up. The dollar was not up. It was down, but it was up relative to everything else. International equities were outpacing. They were down too, but at least they were outpacing. Commodities outpacing equities as well. Both Qs and small cap stocks really struggling. And they've had a nice little rebound, but you can see developed market stocks are up at their highs of the period. So they've gone well past its previous peak, because those international stocks are actually up a month later after the market peaked. And then you can see now they're up even higher now than we were then. Gold is still up after it declined, still up 10% since that level. The dollar has been down, but rallied here the last couple of days. In fact, if we just look at just today alone, so we'll go to May the 12th and look at just today, big time drop in gold, big drop in gold, big drop in bonds. So safety trades all down except for the dollar. The dollar was up. So remember, back in the day, back in 2022, the three-headed monster that really put a lot of pressure on risk appetite was rising yields, rising commodities, and rising dollar. And we had all three of those things again today, and the markets were up huge. I mean, the Qs screamed higher at 4%. In fact, when you look at the ratio of here, where is it over here? When you look at the ratio chart here of the Qs relative to IWM, they never really pulled back. We've had this decline, this correction. So unlike 2022, when we had that correction, you can see the weakness in the Qs, right? The Qs really struggled against IWM. Well, we've had a correction here since February the 20th right here, and there hasn't been any weakness in the Qs relative to IWM. It's still, the Qs are still very, very high. Remember, these are about the same levels. If I were to go all the way back to 1999, I think this doesn't quite get all the way back to 1999, if I remember correctly. Let's go to 1995. Yeah, so it doesn't quite get back. It gets back to 2000, but you can see that this is about the same ratio, the same level as we were at back during the tech bubble peak. So like, at least in 2022, we had a little bit of a correction. Brought it down to 1.5, the ratio down to 1.5, so we were able to get back up to 2 with a bounce, and eventually now up to 2.5, or at least really close to 2.5. But not this correction. Again, as short as this correction was, it hasn't really produced like a decline or and a big drop in anything. In fact, when you look at, again, high yield relative to so corporate bonds relative to their treasuries, we did get a little bit of a decline here. Let's go just to a 1-year chart. And you can see, look at that big jump. So just like that, way above the 200-day moving average. So we did drop below the 200-day moving average, but a big jump higher, big move back up to the upside. You can see everything is moving higher. And if you look at the LQD relative to its equivalent duration, oops, let's try that again. LQD relative to IEF, which those are the equivalent durations there. You can see it hasn't rebounded nearly as well as high yield. I mean, it's still below its 200-day moving average. At least it's above the 50 today, but it hasn't rebounded nearly to the same extent. So you can see this, the strength, but it's interesting to see how, like when you look at like the dollar and bond yields, right? Bond yields especially, we were just here, like here on April the 11th, we were just near similar levels. We were at 4.49%. Today, we got to a high of 4.7%. And when you look at SPX on April 11th, this is where it was at, right here on April 11th. We were well below moving averages. We were at 53.70. We're up almost 500 points since then, even though back then our rising yields put pressure on equities during this period of time that we had this drop here. There we go. We had like over here in February the 20th that we initially had a drop, but then we had a rise up to this bear tag. I mean, this put pressure on yields, and then this jump higher here too. And here we are again up there, up at the top end of the Fed funds rate. And it's doing, but the good thing, here's the good thing about all of this, is that I've told you before that the market, the markets do not like rate cuts. I know everybody thinks they do because you'll hear talking heads on TV talk about it. The market doesn't like rate cuts. The market likes having the cuts on the table, but they like to take them off the table. So you can see here, the odds of a cut now have really dropped down for June expiration. If you look at June expiration, there's an 88%, only a 12% chance we get a cut. That's way lower than where it was. I mean, just a while ago, just there on April the 7th, there was a 99% chance we were getting a cut in June. A 99% chance. Back when this all started in February the 20th, so right here, we had a 47% chance of no cut, 53% chance. And then as the market fell, we went all the way to a 99% chance of a cut. And for that matter, there on whatever day that was, April the 8th, we had a 50% chance of two cuts by then, right? We had a 100% chance of a cut in June of one and a 50% chance of a second one. And that was on April the 8th. Obviously, things have rebounded from April the 8th, and so have the odds of no cuts. The market doesn't like cuts. And right now, in September, you can see again the odds of a cut in September have moved to only to 80%. But just to give you some perspective on the historical, back there on that April the 8th time frame here, right there on April the 8th at the lowest point, there was a 100% chance of a cut. There was a 98% chance of two cuts. There was an 80 some odd percent chance of three cuts in September. So we had a very high probability that we'd start cutting in June and go all the way through the end of the year. But now you can see all of those cuts. The third cut got taken off the table. The second cut got taken. This is the first cut. This is the one cut here. Just a couple of weeks ago, it was a 100% chance, and now it's only a 20% chance of having no cut here in September. So the market loves that. The market's been rallying during this period of time to go from 2.7% up to 20%. The market loves that, and of course, we've been watching that December contract because if we get 5 cuts by the end of the year, starting in June, then we're going to be in bear market mode, right? At the very least. And you can see now, as of right now, by the end of the year, there's a 96% chance we get 1 cut. There is a 78% chance of 2, and then a 40% chance of a third one. So right now, the market's saying there's a pretty decent chance of only getting 2 cuts, and that would be probably a September, December kind of token cuts, a mid-cycle adjustment, right? Because again, they don't usually skip meetings, and they don't ever really start in October like in these off meetings. They like to start a cycle of cuts or hikes in the meetings where they can also issue projections, so they can give people a heads up on potentially how long they're going to be hiking or cutting those rates. So as these come off the table, the market loves that. So you can see the 3-month is still here, so there's no cut coming. The 2-year has rallied up here significantly, back up to 4%. You can see it's at 3.88 right there, but it's actually up closer to 4% right now. That's a really, really good level. That's almost back where it was here when we started this decline at February the 20th. If you look at the yield spread between the 10 and the 2-year, this is the 10 and the 2-year, you can see it's stuck there at 50 basis points. Remember, the market loves this to fall. And what makes this fall, as of right now, there's 2 things that would make it fall. Either the 2-year is falling faster than the 10-year because the Fed's cutting rates. That would make this rise, is when the 2-year falls faster than the 10-year. Or if the 10-year rises more than the 2-year, is the other way. And right now, the 10-year is rising up to 4.45% and making another run at 4.5%. And again, when this whole thing kind of started, we were sitting here right at 4.5%. So a move back up above 4.5%, again, with the 2-year yield not rising as much, would bring this spread back down. The market loves a falling yield spread. Does not like a rising yield spread. Does not like rate cuts. It likes cuts on the table out in the future, but then it loves to take those cuts off the table. The market loves that. And so if we're going to get, I saw Tom Lee posted his projections of 6,600 by the end of the year, which would be a 12% return for the year. If we're going to get a 6,600, then we can't have any cuts, maybe in December, but we can't have any cuts by the rest of the year. To be that bullish, we have to just keep taking the cuts off the table. And so far, so good in that regard. The other big benefit, the other big thing that happened today too, was your dollar index. Look at that bear tag. Really good bear tag. So we have the potential for a new run starting here on the US dollar. If you take a look at the correlation, generally speaking, a rising dollar has been bearish for equities, but not lately. Like right now, as you can see, there's a pretty strong positive correlation between the S&P 500 and the dollar index. You can see that was the case over 2 weeks, and it's a case right now over 3 months as well. Very, very strong positive correlation. So the more the dollar breaks out to the upside, the better, right? So and that's a nice little bullish pattern at that bear tag on the dollar. And you can also see here too, you're above the 30-day, you're sitting at the 50, but your MACD is positive. You got a lot of positive patterns developing here. If you look at the DMI for the dollar index, I showed you the breakout here on the S&P. We got a bullish crossover on the dollar. Everything's showing much, much better. And then finally, the other factor that's been pretty negative for the markets here lately is this falling commodities, especially in crude oil. But crude oil's had a nice little run now. It had a little bit of an upper shadow today, and it's up at the 30-day moving average, so it needs to kind of get through this. We're still below the value area, still well below the 200-day, and for that matter, the 200-week moving averages. But still, very, very good move for the crude oil over the past few sessions. About the past week, we've had a nice run off of strong lows. The market needs crude oil to continue to begin. Crude oil and commodity prices just in general rising is a sign of increasing economic growth expectations. So, if these tariffs, if this, this pullback in the, China deal and this pullback in tariffs, if they're going to, if we're going to see a positive impact from an economic perspective, then we should start to see commodities start to rebound in a very big way, especially crude oil. And today was a good start for something. It wasn't the greatest, like I said, long upper shadow on crude, and you had, again, we gapped up so much, then we had this filled in candle. So it's not the greatest move there. We haven't broken through resistance level, but still, the last week has been very positive and something we hopefully can build on and continue to push higher. There's your market forecast on commodities. Nice, the bear tag itself. Now when you look at crude oil, almost had a bear tag. We just ended up with that long lower shadow. So those bear tags, they can be bearish patterns if we don't build on them, but they can also start new bullish intermediate runs. And so, until otherwise, we're going to anticipate the trend change until we see more of a failure there. Let's take a look at the sector rotation. This is also a very positive development for the markets. When you look at the sector comparison chart, again, you can see things are starting to rebound in a nice way because technology and discretionary were so low for so long. But when you look at just today alone, big time moves in technology and discretionary. So when you look at this on a ratio, on a relative basis, we're seeing exactly what we want to see. Nice rotation into the cyclical XLC, XLY, XLK, all moving up. Everything else moving down to the right, or down to the left, excuse me. You can see the weekly indicators moving up to the right and starting to roll over. There's technology and discretionary moving up to the right. So, very, very good moves here. When you look at the just the chart of XLK itself, you can see XLE moved up, but big time move higher. Now there is, we do have to be aware that, that is not so much of a breakaway gap here as there was, say, on SPY. So, there is the potential that this is a that is a exhaustion gap, something we have to keep an eye on, especially considering that the relative strength is sitting right at the 200-day, and this ratio is very strongly correlated to the S&P. It's really oversold already with the RSI. The PPO is high, the CCI has been high, and we still don't have a crossover yet on the DMI. So, again, this is a great move, but we do have to be aware of the potential for exhaustion in this kind of gap up to the upside. The DMI doesn't look great on XLK when you look at DMI here. And I'm focusing on XLK, just like I've always told you, that that's the sector that's going to lead a rebound to the upside. And that has been the case, right? It has led the rebound here to the upside off of those lows. I'm trying to get to the DMI. There we go. We need it to be the big mover up to the upside. That's a very, very strong move. And if I were to cut that in half to kind of take a shorter term view of this, big time move, right? So, again, the last time we had this big of a move was over here. We didn't really build on it there, but we also weren't as high above the moving average. And you can see we can get higher, and the ADX can get higher as well. This is a big breakout pattern for XLK up to the upside. Very, very parabolic. When you look at its Bollinger Bands and its Keltner channels, you can see, again, it also way up above its Keltner channel and also at that 90th percentile, close to its 1 year point of control on the chart, and about a stronger momentum. So, big gap here, and the last thing we want to see, this lower shadow turn into a gap fill in the next few days. So that's something we're going to keep an eye on XLK and the rest of the market as a whole, to see if, again, today's change in sentiment is an actual trend change and not just an exhaustion of what has already been a very strong move to the upside. When you look at the zigzag and you look at S&P we showed you, but if you look at XLK, we're up 21% off of that low point, and much less off of this. So, again, are we going to have an exhaustion because of how much we already are up? That's something we need to watch for the rest of this week, that we do not fill in the rest of this gap, because it would make it a common / exhaustion gap. And again, would be more bearish than if we were just to roll over without that gap move to the upside. All right, that brings us to our trade idea of the day. Let's take a look at Toll Brothers. The housing stocks have been trying to rebound themselves. Got a big boost today. You can see we had a bear tag already. We've been trying to build on it, but not really doing much of anything until today. Nice little breakout today. We got the dark green shading. We got, the near term line is not necessarily the most bullish, but it is coming off of a bullish low point here. And we have the green line here. We're 9% above the moving average, which is a good amount that we've been. If you look at the long-term chart for Toll Brothers, we got a green arrow. So good bullish candle closing well above the 10-week moving average. The Hakinyashi close. Good sized candle here. The PPO is starting to rise from strong bearish levels. If you look at the 3 green arrow chart, you see that nice good 3 green arrows and a green line now, just like the rest of the market. And if I were to take a look at some of the let's look at the 2-line version of this. you can see that we are breaking up above the 50-day moving average finally. So that's a good sign, you know, potentially to fill in the gap up to the 200-day or point of control, or there's going to be some resistance in that area. Let's take a look at the DMI, some of these other oscillators here. The DMI looks positive, breaking above 30 on the positive indicator, below 20 on the negative indicator. If I look at the RSI and the CCI, they're also showing strong, good bullish breakout levels. Above 60 on the RSI, above 200 on the CCI. Those are all, both of those really good levels there. If you look at the Ichimoku cloud, trend strength indicators, we're into the cloud. The rate of change has just turned positive today. You can see we have close to an intermediate strength trend developing. If I take a look at the Bollinger Bands and the Keltner channels, you can see that we are up against the upper band, again 90th percentile roughly, just like the market, and we are above the upper Keltner channel, just like the market, with some rising momentum that's not as extreme as the market's there. So I like the setup on this. So what I decided to do, if I can get my mouse to work here, is come over here, and we did a long call trade going into that, just short of the resistance. The resistance is right around 125, 126. So we sold that low 20 delta right around 120. Bought the 115 for protection's sake. If I take a look at the risk profile here, if I can get my cursor to work, there we go. Oops, come on, single symbol. And I need to look at market outlook. You can see for a June expiration, so almost a 3-to-1 reward to risk ratio, and I've got a lot of room to work with in terms of where that maximum gain is. As long as it's inside at the 1 standard deviation window, then we're good to go to let that keep running. There's our trade for today. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.